It is time for the halftime show. 4 hours to go until the close, and here's where we stand today on the street. The Dow is hanging on to positive territory by just about 17 points. You look over my shoulder here, S&P, NASDAQ negative at this hour. And here's what we're following at the half. The path to 1,600. Stifel Street strategist says we'll get there sooner than you think, and he's going to tell you exactly how. Open house, Toll Brothers wows the street. Should the stock make a move into your portfolio? Our traders debate that just ahead. But first, our top story, dueling over a cliff. Now that the White House has rejected the latest offer from Republicans, where do negotiations go from here? And what does it mean for your money? Our traders for the hour, Joe Terranova, Stephen Weiss, Mike Murphy, and John Nigerian with us. Joe Terranova, I'm going right to you. The other day you were bullish. The other day you were fighting with me why you like this market. Now today you're cautious. Tell us why.
Well, what I have done is begin to pare back risk, and using the word cautious I think is correct. If you go back to November 16th, it seemed as though at that moment when the S&P was trading 1343 that our policymakers in Washington, D.C. responded to the market. In fact, Pelosi talked about the market on that Friday, and that's where the encouragement came. I think where we sit now, the market is going to force the hand of D.C. policymakers. I still think we get a fiscal cliff deal done, but I think the data that we saw in the ISM yesterday was lousy. The employment component was the worst we've seen since September. I think on Friday we're going to get a horrible unemployment report. I think the market is going to force the hand here to get a deal done, and this is a tactical call more than anything else, taking off some risk.
So Joe's gone a little sour on the market, Murph. Where do you stand today?
I'm going to stay as positive as I was a week ago. You know, I think you look at the S&P, and that's why I'm going to stay positive. The S&P is sitting right around 1407 right now, and if you look the whole way down, when the S&P held key levels, it rallied off it. It broke through those key levels, went down, found support, and now has moved back higher. We're looking 1425 on the S&P for an area to break above. So I think I will agree with Joe, though, that right now with the data you're seeing, with the ISM number you saw yesterday, Washington has to get something done. Whether it's before Christmas or before New Year or after New Year's, I think a deal will get done and the market rallies.
Steve Weiss, does the data we've gotten over the last couple of days all of a sudden change the game? Because you've had a guy who's been bullish, who's been defending the market.
Right.
Every move lower, it's come back and he's defended it. Now we're talking about where we go from here. Where do you stand?
Well, I have taken risk off, and that's about a month ago, because I didn't see the market doing much between now and the end of the year, and I'm worried about next year when the austerity measures take hold. So if you're really overweight equities at this point of the year, you're playing for one thing. You're playing for a resolution to the fiscal cliff that you can live with, because that's really the only near-term event that's going to get it going. We've had China come with better data, but yet the Chinese market's down. So our market's not really believing that. We've had some better news out of Japan, but Europe continues to worsen. So there are lots of issues out there, lots of reasons to be negative, plus corporate earnings, and let's not forget that, they're coming down. So I remain cautious on the market.
Let's find out just how realistic a deal is. Jared Bernstein is the former chief economist of Vice President Biden. Tony Fratto worked in the Bush 43 White House. Both are CNBC contributors. Gentlemen, it's good to see both of you today.
Thank you. Nice to be here.
Jared, is the White House going to accept anything but tax rates going up?
Well, they've never completely closed the door on that.
I mean, it's like maybe just a crack, and I mean, it's a small crack, Jared.
And it's a very small crack, and it might even be closing. I mean, they are very much about the higher rates. The thing that I think the White House is having legitimate problems with in this new offer from John Boehner is the lack of specificity. You know, Tony and I have argued this a lot, and he makes a good point, which is, do we have to argue about rates versus base forever? I take that point, but we can't talk about base unless you want to be specific, and at this point, Republicans have done the same thing Mitt Romney was doing. $800 billion in new revenues from unspecified loophole closures. Boy, the time for that is so past. So I'm glad they're coming with a counteroffer, but they've got to put specifics on the table if we're going to get anywhere.
Tony, under any circumstances, as you sit here right now, are Republicans going to agree to let tax rates increase?
Look, I find that almost impossible for Republicans to do, at least before December 31st. And look, I think everyone understands that it is the single thing that the president wants more than anything else. I think it could sacrifice just about anything to get the top two rates. So I don't see Republicans giving on that issue until they're in a position where they have to do it. I think what you are seeing, and, you know, I think we should give credit to Speaker Boehner for rising above with bringing the proposal yesterday and getting the full Republican leadership on board, where we're talking about specific numbers, and we can maybe see the beginning beginnings of the contour of an eventual agreement. But it's just not going to come. I don't see how it can come before December 31st, and it's going to have to happen afterwards because they're not going to take an active vote that way.
So let me reflect on that for a second. Two things. First of all, I actually think we're going to get a resolution to the fiscal cliff. I just think it's going to come after we go over. Mm-hmm. So that's not unlike
we agree. We agree.
And the idea there is that actually Republicans can claim a tax decrease. That is, you can take the rate down from 39.6 to 38 or 37. Something like that. The president gets what he wants, which is higher rates. The Republicans can claim victory as well because they're lower than they would have been otherwise.
Let me throw it out there this way, Tony. Let's assume that we do, in fact, go over the cliff. Sure. As both you and Jared suggest that we likely will. The market will likely go down and go down hard. A new poll suggests that if we do go over the cliff, that Republicans are going to be the ones who are going to be blamed. How are we going to deal with that, with the market being held hostage by these negotiations, which seemingly, at least in public, are going nowhere?
First of all, I think the markets might do better to listen to, me and Jared rather than whoever's telling that this is going to absolutely get done and that Republicans are going to cave and that's just what's going to happen. I mean, they should listen to us a little bit more because the politics of this are really, really important and make it very difficult for the sides to come together before January 1st. I just think it makes it really, really hard. We should all be pleasantly surprised if it happens. I think there are people who want to have it happen beforehand, but we should need to prepare them for the more than likely cases that we're talking about January fixes on this stuff and not December fixes.
And I also don't believe that the market necessarily goes down hard. I think it does go down if we go over the cliff. I think if there's a plausible, credible plan that just isn't complete yet on December 31st, the kind of scenario that I was discussing earlier, I think the market could take a relatively small hit.
I just throw out the number 777. You guys know what that number represents?
I was standing next to President Bush watching the TARP vote go down when 777 came up on the screen. So I'm very, very familiar with it. I don't think that's the same kind of scenario that we're looking at today if the messaging from policymakers in Washington is good enough to talk about how we can deal with mitigation of some of the impact of the fiscal cliff.
Tony Fratto, Jared Bernstein, it's great to have both of you with us. I appreciate your time very much.
Thank you.
Have both of you back soon. So, Dr. J, you've heard the arguments. They said the market shouldn't be looking at this or listening to what we're hearing in public so much. How are you trading the action we're hearing as you sit there in Chicago today?
Well, I'm putting on positions that are less susceptible, Scott, to some of the volatility that I anticipate is going up. I mean, the VIX is up 14% since last Friday. The reason for that is, again, same the president's offer and then Boehner's counter offer. That's why the VIX, in my mind, has moved up this much. To Stephen's point, as far as negativity, I see a lot of positives potentially going out there. I mean, look at Germany up 22%. We'd take that for our performance out of our market this year. But the reason that the world is waiting is if we really do push all the way up until the cliff and a decision is not made with a little bit of a look back until 2013, even if the rates remain roughly about the same, I think we're really dancing with the devil there. And the rest of the world is already making decisions. We've seen it from the dividend payers and so forth, and the acceleration, Larry Ellison and everybody else accelerating dividends or declaring specials. I think all of that is potential negative going forward into 2013.
Now, guys, the market is negative across the board. So let's throw this out there. Do you agree with what both Jared and Tony made the argument that as long as we get a bit of the framework in place before the end of the year, that the market doesn't go down, in my words, hard, which Jared didn't think it would do? What do you think, Stephen Weiss?
I don't think it goes down hard. I think it's going to be a little bit like the downgrade of the U.S. debt, where everybody said, okay, our debt gets downgraded, market's going to collapse. Well, guess what? It was talked about so much before it happened that when it happened, the market traded up. I think we're in a similar situation. If you take a look, forget about the politics, and you take a look at who's got the best bargaining position in terms of the fiscal cliff, you have to come out with who's sitting in the White House, because if he does nothing, it's exactly what Jared said. So I think that's what ultimately happens, and then the market looks to the deal next year, and then the market goes up. But I don't see a very big hit to the market from a deal not happening.
And exactly what you just said is one of the reasons why tactically I am cautious here. The Republicans really do not have much. They're not golden in terms of negotiating right now. However, They could wait around for Friday. If we do get a lousy unemployment report, well, then they've got a little bit that they could push back against the president.
But you can explain that because of the storm, the employment report.
But I don't
think
think all of it is going to be explainable by Superstorm Sandy. I think a lot of it is obviously the enterprise space pulling back. You're seeing the capital investment. You're seeing new orders contracting.
We got to move on, but I got to push back on one thing. Are we talking about two different things? When we got downgraded, the market went down hard. We lost more than $1 trillion in value.
But the market came right back and actually went to new highs not that long after that, once the knee-jerk reaction was done. So I'm not talking about a knee-jerk reaction if they say no deal and it'll peter out there, but the market's being sensitized to it right now, and that's a good thing.
All right, let's move on. Coach and Oracle, two of the latest companies to issue special dividends ahead of the fiscal cliff. And if you're keeping score at home, that's 103 companies thus far this quarter, valued at more than $22 billion. So we just see this continued parade, Murph, of companies just coming out and issuing special dividends, whether they're doing it with debt or with cash from the balance sheet.
Right. So the debt, I think the big one there, Scott, is Costco. But remember, last week when Costco made this announcement, the stock had a really nice pop. It was up 5, 6, almost 7% on the news. You look today, Oracle moves their dividends up, and the stock is flat to down on the day. Coach announces a special dividend. They're down. I think the market is pricing in. It's been so over talked about. I think the market's pricing this in a lot, and the special dividends are not going to have the same impact that they had a week, 2 weeks, 3 weeks ago.
Good point from Murph, Doc. What do you think about that? Once the luster of these dividends wears off, so to speak, what happens to some of these companies? Are you watching some more than others, one specifically over the rest?
Well, sure I am, Scott, because I still think that Google and or Microsoft could declare a dividend that's bigger than all of the dividends declared so far. Because, as you said, it's about $22 billion. Both of them could easily do that if they wanted to. But I'd go back to what Murph was talking about here as far as going forward. A lot of the demand when you did that cash for clunkers, that pulled demand forward, demand that would have been out there months into the future. In the case of these dividends, like Larry Ellison just did, this is money people would have been getting in 2013. Granted, they're getting it at better tax treatment by getting it in 2012, but they are not going to be getting this money. As is Mr. Ellison
himself.
Yeah, they're not nearly $200 million just for him, but they're not going to be pushing this money out in 2013. That could be a little bit of a pull, a negative out in 2013 for all the ones that are doing what Larry Ellison's doing.